Hello, hello, hello. Welcome to the first webinar of 2024. Tonight we're going to go through how to find sector and industry leaders. We're going to wait about a minute and a half, and we're going to start. Give people an opportunity to hop online. Should be a fun webinar. As you can see, there's only 7 slides, so it's not very big in the slide category. Took your guys' constructive criticism the last few times that we've run these webinars. And I've tried to make it as hands-on as possible. Charts, data sets, websites. It's a lot more fun and interactive than just staring at slides. But I do need to point one thing out. Sometimes dumbing down trading concepts takes away the edge within those trading concepts. So there's kind of a rush right now in this short form content type of market. Everyone's rushing to get headlines. They need your attention. 5 seconds here, 5 seconds there. Trade idea here, trade's dead here, etc. That they really try to dumb down some of these complex trading ideas, strategies, systems, to the point where there's no edge. So we are going to be diving into data here. We are going to be looking at historical trades that we've taken within TTI over the last year and a half. We're going to be showing you 3 or 4 different ways to utilize this industry and sector strength. And hopefully the goal here is to get you guys to be able to implement it within whatever trading system you're utilizing. Whether you're swing trading, day trading, or scalping, you can find a place for this to hopefully put you in better positions when it comes time to finding the stocks that you want to trade. Okay, so without further ado, January 16th, 2024, welcome to the first webinar of 2024, hosted by myself, Hamilton, with the Trading Initiative. Tonight's focus is going to be strictly on how to find sector and industry leaders. We're going to start off with a couple slides here, but as always, I want to start off with a quote. If you know anything about me, if you are a technical trader, the name Thomas Bulkowski should pique your interest. ThePatternSite.com might be the mecca of technical trading. If you have not ever gone to that website, thePatternSite.com, I highly encourage you to go and check it out. It looks like it was built back in 1998 on GeoCities. The guy has quantified nearly every single chart pattern, candlestick pattern. He's back-tested systems, strategies, and indicators, and kicks out all this incredible data. So instead of just believing what you hear on YouTube, even from me, I challenge you to go look at the actual back-tested data to confirm it. I seriously challenge you to do it. So we're going to look at that. We're going to start off with a quote by Thomas Bulkowski. This is what he found, or the quote he had when he found out the edge in trading sector and industry strength. The results are startling. You want to make money in the stock market over the longer term, as short as a month to as long as 2 years, but probably longer. Pick stocks from the top industries, preferably from the industry showing the best relative strength. Avoid selecting stocks from the industry showing the worst relative strength unless you're looking for stocks to short, which is complete ass backwards from the way most people think about trading. They want to buy low and sell high. Well, what happens if I told you it's more profitable in the long run to buy high and sell higher? What happens if the data supports that? What happens if the data supports shorting low and covering lower instead of shorting high and covering low? Since some stocks within an industry can be hurting, you will want to be selective and choose the strongest relative strength among them too, which is what I want to get into next. It's a little caveat off of this idea of industry and sector strength. It's something called relative strength. And it's an important concept, not only within TTI, it's one of the 3 pillars that we utilize every single day. We think it's one of, if not the most important thing in trading in terms of concepts, if you will, this idea of relative strength. Bulkowski and every single person that utilizes a sector and industry type of mentality uses something called relative strength. I want to point out this is not the RSI indicator. That is not relative strength. That is the relative strength index, okay? 2 completely different things. Wilder came up with the RSI to give us an opportunity to trade momentum bursts or mean reversions. This, on the other hand, is a completely different concept with the same name. Relative strength involves comparing the performance of different assets over a specified period. Say that again. Comparing the performance of different assets over a specified period. This analysis can help traders identify which assets are performing relatively better or worse, in the case you want to short, than others. Assets with strong relative strength are those that have outperformed their peers, while those with weak relative strength have underperformed. This idea of comparing different assets against each other to find strength is paramount to understanding the idea of industry and sector strength. We're constantly on the hunt in bull markets for what is the best performing stock at the time, and can we buy that stock? That is what every bullish trader should be looking to do in a bull market. And in a bear market, what is the weakest stock that makes sense? We don't want to short something that's down 99% and is maybe 50 cents on the dollar. We don't want to do that. But within reason, what is the weakest stock that still has meat on the bones that we can continue to short? It's weak for a reason. So this idea of relative strength is important. A couple slides here, and then we're going to move into some interactive content. I want to ask you a question here. Which is the better buy between the two charts? This is not a loaded question, but I want you to focus on a few things here. One, they're relatively the same. This particular setup looks relatively the same, which is another key concept of this relative strength idea in general, not necessarily industry and sector strength, but when you have two assets, right? And you can only own one. You have $100 gun to the back of your head, choose one. How do you choose one if both of them have relatively the same setup from a technical standpoint? I'm going to introduce you to something called a ratio chart. So through relative strength, what we can do is we can divide the absolute performance of one asset against the other. So ratio charts unlock relative strength. The absolute performance of asset number one divided by the absolute performance of asset number two. You can do this in TradingView very easily. If you want to see which was the stronger of the two stocks between NVIDIA and AMD, you would type NVIDIA divided by AMD, and it's going to spit you out a graph like this. This is called a ratio chart. This should not be based off of any sort of technical support or resistance because there's no buying or selling on this chart. Instead, what we simply want to look at is the relationship between the two assets. The trend, that's it. In this case, if the intermediate trend, is heading up, it means asset one is outperforming asset two on an absolute basis. It's important, absolute basis. If they're going sideways for a period of time, it means neither assets are outperforming. They're relatively the same. They're either both going up at the same rate or down at the same rate. If it's in a downtrend, it means that asset two is outperforming asset one. It might seem confusing at first, but it's not. Do this a few times and you'll understand. Asset number one divided by asset number two. In an uptrend, that means asset number one is outperforming asset number two. So let's go back to the original question. Which is the better buy? You look at this. Some of you might have said chart number one. Some of you might have said chart number two. But at the time, this was a training decision we made inside of TTI. This particular point right here. This is hard. How do you decide which one to own? If the technical setups are the same, and I'll give you a little hint, they're within the same sector, right? You could divide them and find which one is outperforming the other. And in this case, it was Microsoft against Apple off of the October lows, just as November started to kick up and we saw a Brett thrust and we wanted to get long the market. Now, I want to point something out. That literally was the binary choice for us to own either Microsoft or Apple. We knew Megacap Tech was going to continue to run at the time. They were leading all year. We didn't want to own both Microsoft and Apple because what happens if Megacap Tech stocks did get hit? We didn't want to get crushed in two separate positions. We just wanted to get crushed in one. And in this case, we looked for the stronger stock. So once again, really quick, at the time of buying, they looked relatively the same setup, both pushing in towards potential all-time highs with a pullback. We did the relative strength, the ratio charts. We saw Microsoft was outperforming Apple. We bought Microsoft. Is it a coincidence that Microsoft closed near all-time high today and is continuing to push? Apple is down 5 to 6% off its all-time high. We would argue no. You do this over a large enough sample size, this ratio chart, these relative strength concepts will put you in bigger wins and typically put you in trades that will extend longer than what most trades would. Microsoft is still pushing up and to the right. Apple is pulling back. So that was the right call for us right off of the bat. So this idea of relative strength and ratio charts is important. Okay, so I want to break to, let's talk about TradingView really quick, actually. Let's go to TradingView. just to show you where we were looking at the time. We were looking to buy Microsoft above the 340, 342 area. Subsequently, Apple was also breaking out around the same time, 178 to 180, and we ended up choosing the right name. So to show you guys kind of what we were looking at the time, the buying opportunity on these was back here for Apple. Still would have been a good trade, but underperformed. And Microsoft here, which is another hallmark point of this idea. Both trades could work, but one worked better. And that's what we want to consistently be putting ourselves in front of. So I want to show you something. Let's see here really quick. Looking at my notes here, I want to make sure I get through all of this stuff. We can also look really quick. It's not only ratio charts between different asset classes where we're looking at strength in terms of individual stocks. We can use ratio charts for anything. And one of our favorite that we utilize in TTI, and something that you guys really liked last webinar, so I want to bring it up again, is this idea of in an intermarket relationship between consumer discretionary and consumer staples. So what we did right here was XLY divided by XLP. So we're taking the absolute performance of consumer discretionary, dividing it by the absolute performance of consumer staples. And if you know anything about those two specific sectors, in a bear market, staples or defensives tend to perform better than discretionary, higher beta stuff. In bull markets, discretionary / higher beta stuff tends to outperform defensives and staples. That makes the most sense. There's higher potential reward on those. So in bull markets, the market wants to own them. Excuse me. By dividing those two, we get the ratio chart and the strength of each of those assets. In a downtrend, back in 2018, we had a bear market. We had a pullback in 2018 that seems like so far ago, but at the time we thought the world was ending. Staples outperformed discretionary, and we saw a downtrend in that ratio chart. Bull market started at the bottom of COVID. Discretionary absolutely killed staples, which is what you would expect in a bull market. We peaked at the end of 2021, beginning of 2022. Entirety of 2022 almost, we saw staples outperform discretionary. We came back down, and here we are back within a bullish regime. End of 2022 into the beginning of 2024, we see consumer discretionary outperforming staples. So another opportunity for you to get that ratio chart idea under your belt. I encourage you to go out and actually start utilizing this stuff. Look at different assets. If you have two assets that you're looking at potentially trading, both with the same setups, go ahead and divide them against each other and see if there's edge going long one versus the other. Okay. The next part I want to talk about really quick is the actual data behind this industry and sector strength. So we're actually going to come over here. We're going to look at, here it is. This is the infamous, thepatternsight.com, 1998 GeoCities. This guy is fucking incredible. I'm telling you, spend a weekend deep diving this. Every single thing you can possibly imagine. There are hundreds of chart patterns quantified, candlestick patterns quantified. I'll tell you right now, not to make you guys feel bad, but candlesticks don't have a very good track record. So if you're looking at candlestick patterns, just understand that most of that's probably marketing. Doesn't really hold up very well when you backtest any of that stuff. But that's neither here nor there. Okay, let's look at this idea here. So what Bulkowski was trying to do is he was trying to figure out if the industry relative strength had edge over the broader market. If you bought the right industry at the right time and held it, did it actually give you edge? Now, I want to point out that Richard Wyckoff and Charles Dow came up with this idea. Charles Dow originally 120 years ago. He created the industrial average, the transportation average. We all know who he is, right? Then Richard Wyckoff came out. Everybody kind of knows a little bit, or at least you've heard of it, about the Wyckoff market model, right? Market moves in cycles. You have accumulation, distribution, markup, markdown. Stan Weinstein brought it back to fruition in the 80s. With his stage analysis cycle, stage cycle analysis, excuse me. And all three of these guys said, listen, industry and sector groups move together. And typically the markets favor specific sectors or industry groups. And if you can at least get close to the highest performing sector or industry group, you can almost completely fuck up which stock you buy, and you're still going to outperform the broader market because the market favors that specific industry group. That was the thesis. Charles Dow said it, Richard Wyckoff said it, Stan Weinstein brought it back to life, and now Bulkowski's trying to quantify it. So I'm not going to go through all of this because that's ridiculous, but I do want to point out just the data set that he has here and then kind of read just the last little portion of what he has to say. You have the URL. It's on here. I encourage you to go look at it. The relative strength from an industry standpoint results. The results are startling. This is the quote that I grabbed. I want you to look at something really quick. The table's a little confusing, so if you need a second to look at this, either watch this again, go to the website yourself. But I want you to focus on Group 1, which is the best performing industry groups, versus Group 4, which is the worst. He has top rank, middle rank, and bottom rank. Now, these are specific stocks within those industry groups. So Group 1, there's a million different industry groups at this point, by the way. We're going to go through that in a second. You can make it as complicated as you want or try to dumb it down. We do both. But let's say, just for shits and giggles here, the top rank stock within Group 1 is going to be NVIDIA, and Group 1 is your semiconductors. So what Bulkowski is trying to quantify is owning the absolute best stock within the best industry group. How does it perform over 2 years compared to even the worst stock within the semiconductor space, and then obviously the worst stock within the worst industry group? The fucking results are incredible. Once again, I encourage you guys to go and look at this stuff by yourself. Don't take my word for it. He has all of this stuff available for you to download and backtest yourself. The top rank stock, or basket of stocks, within Group 1, the strongest industry groups, outperforms the market, if you go all the way down to 2 years on average, 98% versus 45% of the next echelon down within the same industry group. So if there's 3 echelons within each industry group, top rank, middle rank, bottom rank, the outperformance is fucking double and some of the top. This is why in TTI we press own the strongest stocks for time. Over time, there is huge edge in owning these. They are market leaders for a reason. You can see over the course of 1 year, 80%, 2 years, 98%. The drop off is literally 50% or more within the same industry group, just the next echelon down. Once again, go to the bottom, the worst performing stocks within the best industry group, and over the 2 years, you see 31%. It's insane. Go to group number 2. We'll say semis are number 1. That's an industry group right now. We'll say number 2, internet stocks, which are kind of similar, but they are distinctly different. Internet stocks might be group number 2. By 2 years, the top stocks perform on average 30%. 30% versus 98% on average. It's fucking mind-blowing how much better that Group 1 performs versus just Group 2. Now go all the way to Group 4. If you own the trashiest stocks in the market, which people are addicted to owning, they think because a stock is cheap that it's going to have a great opportunity to move. I don't know how many times you're going to have to make this silly mistake, but shitty stocks are cheap because they're shitty stocks. That's it. Don't know how else to tell you. On average, they don't perform well. As a matter of fact, the data supports it. Group number 4, bottom tier, over the next 2 years, typically goes down 25%. 1 year, they go down 33%. So you can see market oscillations also impact these cycles. The focus here, though, is we want to, and we don't always get it. Inside of TTI, we mess it up occasionally, but we're generally in the right area. We want to focus on what is Group 1. And then within Group 1, what is top rank? That is the golden nugget. Because if we can buy those and we can hold them, statistically, we're going to outperform over a large sample size of trades. The numbers back it up. I do want to point out a little caveat that a lot of the trades we take in TTI and trades that you're going to take are going to start off as singles. You're not necessarily going to know exactly which stock is going to be the best performing stock over the next year. There are some ways to get a little bit of a head start. We're going to look at that in a second. That ratio chart idea, which stocks are the first to break out of ranges, etc. These little clues can add up, and they typically do help. But realistically, we're not going to know until the end of the year. So you want to put yourself in the position to even have the opportunity to own these. So be obsessed with finding the best performing industry group over whichever time frame you're trading. Inside of TTI, we're trading anywhere between 45 to 120 days, sometimes a little bit further. You guys might be within that 10 to 30 day window. Some of you guys are day trading. I'm telling you, theme plays, which I'm sure you're well aware of as a day trader, factors into this industry strength stuff. All right. So he goes on to say that this might be one of the best things he's ever found in terms of an overall idea. And actually, the study proves that these guys that talked about this over 100 years ago, actually, there's merit to it, which I think it's funny because a lot of the stuff we learn from a TA standpoint, it looks great on YouTube. It's easy to chart, but there's really not a lot of stuff to back it up. In this instance, this particular idea of industry and sector relative strength does. So I want to go really quick to Stan Weinstein. A lot of you guys are privy to Stan Weinstein. We have a webinar on him, the market cycles. Next Big Trades on Twitter. Go ahead and follow him. He's obsessed with Stan Weinstein's stage cycle. I just want to show you two quotes, because Stan Weinstein, if you know anything about him, this fucking guy really wrote the book on stage theory over the last 30 years. This guy is an OG. When he talks, you listen. After years of observing and studying market cycles, there's absolutely no doubt in my mind that sector analysis, so it's different than industry, by the way, we're going to look at both, is just as important as overall market timing. In fact, in certain markets, it is even more important. It's even more important, right? The favorable chart in the bullish group will often quickly advance 50 to 75%, while the equally bullish chart in a bearish group may struggle to move 5 or 10%. That's another thing. Two setups look the exact same. If one's in a leading industry group and the other's in a lagging industry group, 9.9 times out of 10, if you are a top-down trader, you need to be buying the strong industry group. I mean, the stats back it up. The TA on the chart comes second to the overall idea of which industry groups are performing the best across the broader market. All right, so Stan says it, Bulkowski proves it. Hopefully this stuff is starting to resonate a little bit within you guys. So I want to show you really quick how we utilize Koyfin to kind of look through sector and industry strength. We're going to look at Koyfin. We're going to look at sector industry. We're going to go a little bit further and look at market cap strength, which I think is really fun. Something that we do in TTI that I don't see really anybody else do. It sets us up. So hopefully you guys take something away from that. We're going to look at some RRG charts, which is another way to look at these sector and industry cycles, if you will, the rotations within them. We're going to look at industry groups that Bulkowski has, and we're going to look at the OG industry group, which is your IBD groups. You're going to see that there could be, 20 industry groups to choose from or 220. It gets really, really complicated if you wanted to. We like to be somewhere in the middle. So first things first, I want to ask you guys, what do you think was the number one performing sector last year? You don't have to type it out. You can type it out. Just want you to think about it for a second. What was the number one performing sector last year? We go back 1 year. SPY's up 20.99% exactly 1 year ago. Number one performing U.S. sector, tech. Followed by communications, followed by consumer discretionary. By the way, kind of what you expect in a bull market, right? Anyway, did people have this on the bingo chart, if you will? It's not a chart. You don't play bingo on a chart. Whatever the hell you play bingo on. Do you have this on the bingo card? There you go. The bingo card in January of 2023 that tech was going to lead? Most people probably not. Oil's not a sector, but oil did very well. You're right, for a majority of it. That would be your energy. Energy would be the embodiment of oil, which had an incredible 2-year run, but last year not so much. So tech, consumer discretionary, and communications, your top three, all outperforming SPY. Really quick before we get any further, what do you think was the number one performing industry group? This is where things get interesting. I want you to think about this really quick while you're thinking about and typing out which industry you think industry group led the market. Think about it from a pyramid, if you will. And at the top, you have which way is the market moving? Which direction? Is it bullish? Is it bearish? You could do something as stupid as which direction is the 200-day moving average facing on the S&P 500 or the NASDAQ, whatever you want to utilize. So market trend is the most important. The second most important thing is going to be your sectors. The third most important thing is going to be your industry groups. The fourth most important thing is going to be within TTI, at least. You don't have to take this if you don't want to, but I'll show you it. Market caps. And then the fifth thing is the individual stock. So by the time we get to the individual stock, we have already found which direction the market's moving. So we know if we should be more bullish than bearish or more bearish than bullish. We know which sectors are outperforming if we're going long. We know which industry groups within those sectors, because each sector has many industry groups within it, which industry groups are outperforming. Then we know which market caps are outperforming within that sector and industry group, and then we get the actual stock. So when you see on Twitter or YouTube, we don't win all of our trades. Matter of fact, I'm on average over the last decade about a 45% win rate. Last year I was up near 60. It was a great year for us because we were idiots and just went long, because that's normally how you make money in bull markets. But last year was great. I'm generally around a 45% win rate. I lose quite often, actually. I generally make up for it because I'm targeting 4-to-1 or better risk to reward. So over a large sample size, hopefully if I'm doing something right, I'll make a couple bucks. How do you think we consistently get ahead of some of these bigger moves? It has nothing to do with the right guess. It all comes down to this Koyfin idea. So you guys said semis. Number one performer over the last year, semis, software, and home builders. It was home builders for a majority of the year, by the way, which, once again, I don't think anybody had that on their bingo card. Home builders, what the hell? We were supposed to go through a recession. Home builders were actually supposed to be the worst. Ironically, solar and clean energy are the worst. They've been the worst for like the last 5 years, by the way. Lots of meme stocks in those that popped during 2020 and 2021 that have sold off. So semis, software, and home builders. A fun little experiment there because most people, they don't really know. They don't have no idea which sectors or industry groups are leading. It doesn't even occur to them that they should know. So it's always kind of fun. I think the home builder stuff is generally catches people off guard. So I want to look at 3-month. Let's just go back to 3-month and look at over the last 3 months. This is kind of what we do in TTI, right? We think about where is the market right now? What should we be focused on in terms of strength? Go back 3 months. We're in the middle of October. So right before the market bottomed, we're still in a drawdown. Think back to end of October. I think we pivoted on the 23rd of October. I think that was the absolute low, if I'm not mistaken. And we were getting long end of October, beginning of November based off of this specific chart and the next one you're about to see. So right now, over the last 3 months, you see tech outperforming. You see real estate outperforming. You see financials outperforming. Everything else is underperforming SPY over the last 3 months. So if you are a relative strength style of trader and you want to position yourself in leaders, you would be focused on real estate, tech, and financials right now. But you can also take it one step further. This is not a technical chart in the idea that there's support and resistance. It's simply trend. And we also have an anchored start date. So it does manipulate the data. Generally, what I tell the guys, in TTI, is that we want to think about this type of stuff within our time frame on a quarter-to-quarter basis for 2 reasons. One, our time frame is on a quarter-to-quarter basis. We're looking 45 to 120 days out. 120 days is about a quarter, right? Secondly, ETFs, mutual funds, large money managers reallocate stuff at quarter end. And so we see breadth thrusts in certain areas of the market depending on which names need to be reallocated, which areas of the market need to be bought or sold to pass their weighting descriptions of the ETFs. And so quarter over quarter, it makes sense to kind of look at the data. Right now, we go to quarter to date, obviously, because we just rolled over. There's not enough here. We're going back to the end of December, beginning of January. That's only about 2.5 weeks. For us, this is noise. We're going to the 3 month. We know that we should be looking at tech, financials, real estate, and we want to throw a little feather in the hat for names like communications because it's just a very nice uptrend. It's underperforming SPY, but it's an uptrend. We reasonably expect this to break above SPY relatively soon. Industrials is hanging out right there. Consumer discretionary, kind of a little fucked up sector right now because of Tesla. But other than that, what's inside of consumer discretionary, we'll see in a second. Retail, it's doing very well. And healthcare, uptrends. These are underperforming SPY, which is important to understand, but they are in relative uptrends. So let's go. We kind of know where we want to be long, right? Let's just stick with the tech, financials, and real estate right now. We don't have to complicate it for the webinar here. Over the last 3 months, which industry groups are going in? It's home builders, regional banks, semiconductors, internet. Just talking about retail. So Tesla sucks, but retail doesn't. By the way, one of the best performing stocks of last year was Abercrombie & Fitch. Didn't have that on my 2023 bingo card either. You have software names. 2023. Large cap growth underperformed. Your mega cap tech stocks underperformed versus your smalls and mids. There was more opportunity to be long smalls and mids from a market cap standpoint than there was to be long mega cap tech stocks. But now coming into 2024, we see the absolute destruction. And by the way, these are not necessarily going down. They're just underperforming the broader market. So once again, that relative strength concept, which is the better thing to be owning right now? Is it smalls and mids or is it large caps? Well, from what we can see right here, starting in 2024, there's been a resurgence after the first week in large cap strength, specifically growth, IVW. So we know that we probably want to be long again, IVW, large cap growth stocks. We know based off of sector strength here that we want to be long tech, real estate, financials, etc. We know we want to be long specifically within tech, semis, internet, and software. And we know that generally speaking, we're going to want to be long large cap growth, which means we want to be long large cap tech, semi, software, and internet related names. We've built the entire macro thesis all around leading industry and sector groups, took it one step further for factor analysis. This can be challenging for newer traders. It absolutely can be challenging for newer traders. Specifically because Koyfin is not the most user-friendly interface if you don't know exactly what you're looking for. But we can utilize other tools, right? Give me 1 second. We can utilize something called a relative rotation graph from stock charts. All right, so this is just a different way to visualize the same type of data. This is a required, you have to pay to be able to access this, but this is a little bit easier to kind of understand how sector rotations and leading groups emerge. Easy to set up with this 4-quadrant system. You can look at different types of groups. I just chose S&P 500 sector ETFs. We were just looking at it in Koyfin, and you can see which areas of the market are outperforming. Financials, tech, and real estate. They have little 8-week tails, show you over the last 8 weeks how they've been moving. Communications coming from leading into lagging. Weakening, which is probably going to pop back up to leading by the end of this week. We see utilities and staples in the improving, but potentially coming back down in towards the lagging. This is what we want to see in a bear market, by the way. We want to see staples, utilities lag. We want to see tech, communications, discretionary, financials leading. That's what we want to see in a bull market. And that's exactly what we're seeing. That's why we're not ready to pull the cord yet on this potential all-time high pop. But this is another great resource for you. Stock charts giving you RRG. This gives you an opportunity to visualize that sector rotation. And then we also have 2 other instances. We have Bulkowski actually went through, and he quantifies these things, I believe, on a weekly basis. So he has 60, I believe, 60 different industry groups with the largest or most impactful stocks within each one, right? So as of January 12th, he says from an industry standpoint, now Koyfin gives us about 20, and it's a little bit higher time frame type, or not a time frame, but macro stuff, right? We have software in particular, whereas Bulkowski might have 5 different industry groups instead of just software. So he's looking at home furnishings, home building, retail, apparel, internet, IT services, etc. And he's looking at some of the leaders within those industry groups. This is a free resource. If you don't want to take the time to go and find this stuff yourself, you can rely on somebody like Bulkowski once a week to kind of spit out, hey, which areas of the market are outperforming the best? Which areas of the market are potentially the best to be shorting, specifically in a bear market? In a bear market, we're going to be hanging out down here. In a bull market, we want to be hanging out up top. Let's go one step further, the IBD industry group. Bulkowski has 60, IBD has 197. You can knock yourself out. You can get as technical and complicated as you want. This is also free. Updated weekly, I believe. All right? So go and find those industry groups that are leading and then find stocks within those industry groups to trade. If you don't know how to do that, I'll show you really quick. Let's talk through this. FinViz. Most of you guys that have watched my streams have seen me scan. If you haven't, this is the first time you're going to see it. Feel free to steal my scanner settings. I don't care. We're going to tweak these a little bit just for the sake of the webinar. Average volume over 1 million. We're going to go 0 to 5% below the high. We're going to take relative volume over. We're going to go optionable and shortable just so we can get rid of any of the names that maybe we would never trade anyway. And this is what makes this really great. Market cap. Let's go over 10 billion. So we have 274 names within the entire market, 0 to 5% below their 50-day high with average volume over 1 million, optionable and shortable. From a sector standpoint, technology, and we can get all the way down. We can see the ticker, the company, the sector, the industry, the country, the market cap, all of this stuff. Click charts. And depending on what your specific setup is to get long, you can go and get long some of these stocks that are showing leadership roles. We know tech is leading. We know semiconductors are leading. We know the area to be long right now with the market cap bias is large caps. This is a great opportunity for you to go and find some of those large cap tech semiconductor names that are just now breaking out or are giving you some sort of entry based off of your system. Let's go to 50-day highs. I don't know if we're going to get a whole bunch of them. AMD. AMD is the leader here, right? So AMD 5% below gives us an opportunity to, at the very minimum, chart Marvell. Let's go and look at Marvell. I have not looked at this yet, so I have no idea if this is a playable name. Does look like there's a little bit of a horizontal level that we could play the breakout of if you wanted to get long this semiconductor name. I do think this is a more expensive trade. Or is this a different ticker I'm thinking of? Definitely a horizontal level for you to be able to risk. Call this an island fractal, gapped up. Never came back. A little bit of a rounded bottom. Doesn't have to be perfect, right? Bear with me here. Get some sort of price target based off of the island fractal. $78 to $80 is a price target off of the 66.50 breakout. Here's an opportunity for you at a breakout spot. Not a bad place to be. You have a 3-to-1 setup based off of shares here. Guarantee you could find a 4-to-1 setup on the options chain. See how we're doing this? We're building the thesis first. Something that's important from a TTI perspective is majority of the work we put into this is not the actual trade. It's setting up all of the stuff before the trade. It's important to understand that. The macro idea is more important than the specific stock itself in a top-down approach of trading. We utilize the stock as an opportunity to capture the macro thesis. We're looking for the strongest of the strong. This is giving us an opportunity at capturing tech, semis, large caps at a logical area to risk on at. So let's go back really quick to FinViz and let's switch this up. I don't know if we're going to get a whole bunch of hits here, but let's just go to tech in general. Let's go to charts. Cybersecurity stocks, by the way, industry leader and probably going to end up being one of the top leaders like they were last year. Cybersecurity stocks is absolutely through the roof here. ANET, PanW, CrowdStrike. We're going to own CrowdStrike above 296. Little hint there. Marvell looks like these are all tech names, all large cap names. As much as I hate Docu, this does look like a playable setup. Let's go and check. Not yet. Not quite. We're going to want to get up and over 65 at minimum to get into Docu, at least for us. But what is this? Dynatrace DT. There's a horizontal level to risk on. Distance area offering you a cheaper opportunity to get long. So here's another name. This is a tech. I believe it's a software name. It is. Large cap, software, tech. Another name that's probably going to do pretty good because it's in the leading sector, leading industry group, and leading market cap. So you can kind of see where we're going with this. Utilize your scanner to pinpoint the sectors and industry groups, market caps if you want. Find the setups that you like to trade, and then go and buy those. Looks like the stream died. I have no idea if this is still recording. I'm going to continue to talk for about 5 more minutes because I have a couple other things to go through. Hopefully this is, at the very minimum, replayable. We had 50 people, 60 people. I just want to show you kind of the stuff that we talk about inside of TTI in terms of sector and industry strength matters. You see it on Twitter all the time, but really the conversations we have in Discord go really in depth. We have a good kind of bottom out in October. You know, we were kind of on the fence coming into January, but about halfway through January, beginning of February, like we were long. A couple names here. And a couple that I want to point out because I'm not gloating about the trade themselves. I want you to think about the thought process behind it. Because if you think about Q1 of 2023, it was very hard to be bullish. Most people were very bearish. They were shorting the rips. About halfway through the year, they were still shorting the rips. But Q1 of 2023, we were bullish. So I want to point out Meta as the first stock here. want to see where exactly we said. Meta's on high watch for buying opportunity. Here is the actual setup at the time. We took this trade. Once again, this is the very beginning of 2023. Not a lot of people were very bullish here. XLC is green on the day. We were just talking about the communication sector. Google, Meta, this is relative strength. And I think it's important. Identifying relative strength in sector and industry groups can put you ahead of the curve. If you're willing to put aside the bias and trade the charts and the relationships that you're seeing, you can get ahead of these types of trades. And we did. Right? We traded the Junes. We traded Meta twice or 3 times last year. We're still in a Meta trade from last year. So 3 times, 3 for 3, all 3 big wins. Not that you guys need to see it. I'm sure if you're trading, you know what Meta looks like. But there you go. This is where we originally bought Meta. Not a bad little trade there last year. Get ahead of the people. Don't fall victim to recessions coming. Don't fall victim to people telling you that the world is about to end. Let's look at NVIDIA. This was one of our better calls here last year. We were long NVIDIA in February. We did not buy enough time on this to be 100% honest with you. But look at this. We were already starting to get long NVIDIA. I can show you the actual chart here. There's the actual chart on NVIDIA. I mean, that was it. A lot of these charts are the exact same charts we're finding in the market right now. These little basing patterns that are breaking out. In this case, it was a little bit more bearish than bullish because the 200-day moving average isn't sloped up yet. But we were buying off of the January 2023 breakout when the market had just sold off like crazy. Tech was down like 50%. NVIDIA had gone from nearly $350 to $100 a share. That is a huge depreciation. We were buying the breakout back up and over 195, right? I think it's important. We were buying the March 245s. It ended up being a great trade. We traded NVIDIA twice last year, but we left a lot on the table because it became a little bit outrageous. Thankfully, we traded some other names, ALGM, ARM, AMD. Semis were really good to us last year, but we were able to identify the strength in general in this specific industry group. See if I can actually find it. Don't know if I'm going to be able to find it, but semis were absolutely beginning. Actually, semis were the first real industry group to rip last year that we noticed, and we started to get long. So I want to focus on one more thing. Come down here to, let's see, page 5. I have this in my little notes here. I want to show you guys something. In page 5, here we go. Oh, here's the semi thing I was just talking about. This was when we officially got long semis. We were breaking out for the first time. We hit a higher high above the 200-day moving average at the beginning of 2023. Incredibly challenging. This is your semiconductor industry, SMH. Challenging time to get long. Everybody in the market was short at that time. People did not want to get long. We were idiots. I got ridiculed a lot on FinTwit and everything else, which is fine. Generally means you're doing something right. But way back in January 25th of 2023, green light from an industry standpoint, semiconductors. What we're trading through right now is a potential second year bull market with new sector and industry groups setting up to either continue their leadership role after a correction, which happened over the last 2 weeks and is kind of happening right now as but the market churns over at all-time highs, or new sectors and industry groups are going to start leading. Right now, we're seeing strength in large cap, tech, mega cap, tech, some communications related names. We did not expect this coming into 2024, but that's what we're seeing right now. And we are taking positions based off of that. I'll throw you guys 2 bones here. We're looking to re-enter our Uber position above 64. This was an incredible trade for us last year. We traded it off of the original 37 area breakout. We re-added above 46, 47. We're currently pressing in towards 64. We're 2 for 2 on this. We still have marches for that $60 call. We're looking to add in above 64, and we're targeting the $80 area. We're expecting an all-time high breakout. This particular stock is within that large cap growth area that we're liking right now. At all-time highs, we want to continue to own this particular stock. It looks fantastic. Spotify is another one. This one in particular caught our attention because there's very low US ETF ownership. But if you go back a year and you look at the overall performance, this was one of the bigger winners in the large cap space, 176% on the year, giving us a nice little pullback in towards a previous overhead resistance as it continues to potentially show a leadership role. Once again, large cap growth. We have Microsoft at all-time highs. We're not adding into that right now. The other one we want to own in the future is this CrowdStrike trade. So if you watched the previous webinar, CrowdStrike was one of our bigger wins last year, over 1,000% win. We were able to buy it. This is CRM. What am I doing? CrowdStrike, excuse me. Here we go. CrowdStrike, we bought it back here in October. We saw the bounce, absolute ripper. This is a cybersecurity stock pressing in towards all-time high. Large cap tech. Once again, we want to own this above 295, 296. The setups are very simple. What's more important to us is the sector and industry and market cap strength behind it, because we understand that those tend to push individual stocks further than what they normally would. But then when we can focus in on the actual leaders within the stock universe as well, so we have sector, industry, market cap strength, and then stocks, it absolutely creates a profitable situation more often than not. You will really be surprised at how long these things tend to go. A lot further than whether or you're just trading some random stocks here. So I'm going to wrap this up. It looks like the stream did freeze. Hopefully you guys can watch the recording of this. If you have any questions, feel free to contact me at hamiltondrips@thetradinginitiative.com. You can reach out to me on Twitter at howtoswingtrade if you have any specific questions about this specific stream. We do have a daily newsletter going out right now. I highly encourage you to sign up for it. Scans, trade ideas every single day for free. We're not asking for anything except some constructive criticism as we try to pan out the bugs and try to get the highest quality product we can without taking 12 hours per day to write these things. So scratch my back, I'll scratch yours. We'll send them out for free. Feel free to sign up. I appreciate you guys. Thank you for showing up on a Tuesday. I apologize for the stream going down. Blame Elon Musk and Starlink, and I'll catch